Okay, let's unpack this. Today, July 25, 2025, is quite a significant day if you're following India's financial scene, especially credit cards.
Definitely.
We've just got our hands on the latest numbers of the financial disclosures and the investor presentation from SBI Cards and Payment Services.
Mm.
This is for their Q1 FY26, so quarter ending June 30, 2025.
Right. Fresh off the press.
Exactly. So our mission today really is to dive deep into these documents. We want to pull out the key insights, give you the shortcut to understand what's happening with one of India's biggest credit card players.
Looking beyond just the headlines, I think.
Absolutely. We'll get into the growth, the financials, how they're managing risk, and even, their broader impact.
Sounds good. Where do we start?
Let's kick off with the big picture, the top-line numbers that kind of set the scene. So SBI Cards reported total revenue of 5,035 crore for Q1 FY26. That's a solid 12% increase compared to last year, year-on-year. Revenue from operations, pretty much the same story, up 12% year-on-year, hitting 4,877 crore.
Okay, strong top-line growth then.
Yeah, but here's where it gets a bit more nuanced. Profit after tax, the PAT, was 556 crore. Now, that's actually down 6% compared to Q1 last year.
Ah, okay. A dip there.
But, and this is really interesting, that same PAT figure is up 4% compared to the last quarter, Q4 FY25. So down year-on-year, but up quarter-on-quarter. What's going on there?
Yeah, that's a really key point, isn't it? It shows this kind of balance. While the year-on-year dip might catch your eye first, that sequential growth, quarter-on-quarter, suggests, a positive momentum, maybe a rebound.
Right.
It could mean they've navigated whatever challenge hit them last year, or maybe they're just capitalizing better on current conditions. And this is backed up by just the sheer size of their operation, Cards in force, the actual number of cards out there grew 10% year-on-year to 2.12 crore. That's huge.
21.2 million cards.
Exactly. And total spends on those cards soared 21% year-on-year to 93,244 crore. Massive volume.
And that translates into market position too, right? They're holding strong. For Q1, their market share in cards in force was 19.1%.
Making them number 2.
Yep, number 2 in the industry, and that's actually up from 18.5% a year ago. And then if you look at spends, their market share is 16.6%.
Number 3 there.
Number 3, but again, up from 15.9% last year. What does this steady gain in market share tell us?
Well, look, it's not just about getting bigger because the market's growing. It suggests they're actively taking share, either grabbing more new customers than competitors, or getting existing customers to spend more, or maybe both. In a competitive market like India's, growing your share like that, it really points to a strengthening competitive position. They seem to be doing something right in terms of acquisition and engagement. Okay,
so let's talk about how they achieve that growth. New account acquisition. It actually moderated a bit year-on-year, came in at 8.73 lakhs, so 873,000 new accounts. That's down 3% from Q1 last year.
Right, a slight dip there.
But then you see that really impressive 21% jump compared to the previous quarter. So what's behind that Q-on-Q rebound? What's driving the new cardholder momentum now?
Yeah, it's interesting. I think the internal dynamics are key. You see retail spends that's still growing very robustly, up 15% year-on-year to 82,404 crore. That's your everyday consumer spending. But the real highlight, and maybe a big driver of that recent momentum, is the huge recovery in corporate spends. That jumped an incredible 107% year-on-year to 10,840 crore.
Wow, 107%.
Exactly. And that diversification is really important. It means they're not just reliant on consumers. This surge in corporate spending could point to, renewed business confidence, maybe successful B2B partnerships kicking in. It makes them more resilient.
And how are you, the consumer, actually using these cards?
Yeah.
The data is quite telling here. UPI spends on their RuPay card saw a 20% growth just from the last quarter.
Significant jump.
Yeah. And interestingly, the average UPI spend per account each month was actually higher in the Tier 2, and smaller cities, 16,900 compared to Tier 1 cities at 13,600.
That is interesting.
And online spending continues its climb. It's now 54.4% of all retail spending. That trend's been going up steadily since FY22.
So these geographic patterns, the digital shift, what does that signal about wider trends in India?
Well, it raises a fascinating point, doesn't it? It suggests that these smaller cities, Tier 2 plus, they're not just adopting digital payments, they're actively using them for pretty significant transaction values, perhaps even leapfrogging some of the older payment habits. It really indicates a deepening digital financial inclusion across the country, which is a major, major shift economically and socially.
And if we look at where people are spending, some categories just exploded year on year. Travel agents, hotels, airlines, railways, entertainment, restaurant, that whole segment saw a massive 111% growth.
Wow, clearly pent-up demand being unleashed there. Post-pandemic effect, maybe?
Very likely. And then things like consumer durables, furniture, hardware, clothes, jewelry, that grew by a very healthy 57% too. So definite signs of consumer confidence in certain areas.
Yeah, strong discretionary spending. Okay, so after looking at the growth and where the money's being spent, let's get into the mechanics. The financial engine. Revenue from operations grew 4% quarter on quarter. Where did that actually come from?
Well, yeah, the good news for them is that it was pretty well spread out. It was driven by both interest income, that was up 11% year on year to 2,493 crore,
Okay.
and also their fees and other revenue. That rose 13% year on year to 2,384 crore. So quite balanced between interest and fees.
So a diversified income stream, which is generally seen as positive, right?
Absolutely. It means they're not overly dependent on just interest income or just fees.
Yeah.
It gives them more stability.
Right. Now, growth usually comes with costs. Finance costs were up 6% year on year to 813 crore, mainly because they're lending more, higher receivables. And total operating costs rose 17% year on year to 2,123 crore.
Yeah, costs are definitely up.
But on the flip side, looking at efficiency, their cost of funds, basically what they pay to borrow the money they lend out, that actually improved slightly, down to 7.1%.
That's good management.
And crucially, their net interest margin, or in the profit margin on their lending, that also improved up to a pretty healthy 11.2%. So costs are rising, but key margins are improving. What's the takeaway there?
Look, that's critical. Managing to improve both your cost of funds and your net interest margin while your overall finance costs are going up because you're growing, that's really effective management.
Right.
It shows they're handling their borrowing costs well and maintaining strong pricing power on their loans. It's essential for staying profitable while expanding.
Wow.
And you also saw their cost of income ratio improved quarter on quarter to 50.3%, which sort of reinforces that efficiency story.
Okay, essential stuff. But no deep dive into a lender is complete without looking closely at asset quality. How healthy is the loan book? Their gross non-performing assets, GNPA, stood at 3.07%. Net non-performing assets, NNPA, at 1.42%. How should we interpret those numbers, especially with all this growth?
Right, context is key here. So the headline GNPA, 3.07%, that's actually up just a tiny bit, 1 basis point compared to last year.
Okay. Negligible change year on year.
Exactly. But importantly, it improved by 1 basis point compared to the last quarter. So Q on Q, it's stable or slightly better. And the net NPA also improved quarter on quarter by 3 basis points.
So underlying stability there.
Yeah, it suggests stability. Now, the other piece here is credit cost. That went up to 9.6%, which is about 58 basis points higher than the last quarter. That's because they set aside more money for potential bad loans, higher provisioning.
So higher cost looks bad, but it's actually them being cautious.
Precisely. It's a prudent approach. They're strengthening their buffer against potential future defaults. While it hits the cost line now, it's arguably a sign of responsible management, being realistic about risks in a growing book. And their provision coverage ratio, the PCR, is at a decent 54.3%.
Okay, that makes sense. And related to risk, how about their overall financial strength, their capital cushion?
Yeah, very strong on that front. Their capital adequacy ratio, CAR, is 23.2%, and Tier 1 capital is at 17.9%.
And how does that compare to requirements?
Oh, way above. Both are well clear of the regulatory minimums. It means they have a really substantial financial cushion to absorb any unexpected shocks. Very robust.
Good to know. So the numbers paint a picture of growth, decent efficiency, and prudent risk management. But there's more to the story than just financials, isn't there? Let's talk about the other aspects: sustainability, innovation, customer experience.
Absolutely. These things are increasingly important for long-term value. And they seem to be making strides in ESG, environmental, social, governance. They got included in the FTSE4Good Index series, which came after a noticeable ESG rating upgrade to 3.8.
Okay, so external recognition there. What are they actually doing?
Well, on the environmental side, for instance, they're focusing on energy efficiency, things like replacing old equipment, using IoT systems to manage air conditioning and energy meters in their Delhi office. They're targeting saving about 20,000 kilowatt hours a year just from that.
Right, practical steps.
It's not just greenwashing, it's often about operational savings too, demonstrating responsibility.
And on the social side?
Yeah, seems like a focus on employee well-being and community engagement. They did things like observing lights out for World Environment Day, running campaigns on saving paper and water. They introduced sanitary pad dispensers in several offices, Bangalore, Chennai, Hyderabad, and even organized a yoga session for staff on International Yoga Day.
Okay, small things individually, but they add up to a certain kind of corporate culture and image, I suppose.
Exactly. It demonstrates commitment to staff and the environment, which helps with attracting talent, keeping customers happy, and appealing to those socially conscious investors we mentioned. It builds long-term value.
And for you, the customer, what about innovation? Any new features?
Yeah, a couple of things stood out. They've enabled instant WhatsApp notifications if your card transaction is declined because a specific switch, like online or contactless, is inactive, gives you real-time info and control.
That could be useful. Less frustrating than just getting a decline.
Right. And they've also added live chat support on their website. In today's world, faster query resolution is huge for customer satisfaction and keeping people loyal. Less waiting on hold.
Definitely. And finally, market presence. They're still launching new things, building partnerships.
Oh yeah, definitely active. They launched the Tata new SBI card recently in 2 variants, Infinity and Plus. That partnership with Tata Digital taps into the huge New Coins reward ecosystem.
Big potential reach there.
For sure. And they also extended their tie-up with Apollo Health Co., launching the Apollo SBI Cards Select, which is specifically targeted at health-conscious consumers. Shows they're looking at niche segments too.
Right, tailored offerings.
And they picked up some awards too, like from CRIF High Mark for data excellence, low rejection rates, high accuracy, plus a couple of silver abbeys for a marketing campaign. So getting recognition for both operations and marketing.
Okay, so pulling all of this together, this whole deep dive, what's the picture that emerges for SBI Cards?
Well, I think what we've seen is a company that's clearly demonstrating sustained growth, more cards, much higher spending, growing receivables. They're actively gaining market share, which is significant.
Right.
And importantly, they seem to be managing their financial health pretty adeptly. Margins are improving despite cost pressures. Capital adequacy is really strong. And they're taking what looks like a prudent approach to provisioning, even if it increases near-term costs. The Q-on-Q PIE rebound and that massive jump in corporate spending also signal resilience and maybe some strategic wins.
Yeah, it feels like they're not just focused on the raw numbers. That focus you mentioned on ESG, the digital tweaks for customers, the strategic co-brand partnerships, it paints a picture of a company trying to balance that aggressive market expansion with, well, being careful on risk, but also thinking about the future, about broader values.
Exactly. It's that balancing act.
So here's a final thought to leave you with. We saw that really strong growth in UPI spends, especially in smaller cities. Online transactions keep climbing, and SBI Card is pushing these new co-branded cards and digital channels. How might this ongoing digital shift and this push into diverse segments like health or deeper into tier 2 and 3 cities, how might that reshape the whole credit landscape in India going forward? And maybe more importantly, what does that mean for you as a consumer who's probably looking for more personalized, more tailored financial products?